Welcome students. So in the previous class we discussed something about the credit policy changes, and in today's class we will learn about the credit policy changes by the firms and the impact of these changes on the overall accounts receivable and their management, and then say how to manage the funds blocked in the accounts receivables because of the credit policy changes. Because credit policy which is once decided by the firm, which is fixed by the firm, that remains fixed for some period of time, and looking at the changes in the market, looking at the developments in the market, we will have to change the or review the market policy or the say credit policy over a period of time, so that sales amount either can be kept safe, sustained, kept intact, or can be increased. So credit policy is a very important document, and we have discussed in the previous classes that as I told you and emphasized upon, that there should be no flexibility upon the marketing force or upon the sales force to say play with the credit policy. So the outcome, the solution for that is that it should be a written credit policy, and for every borrower or the buyer on credit we should work out the score, so that if somebody is attaining that score or maybe crossing that score, then it is fine. Otherwise we should not extend the credit, because it is not the question of selling on credit, rather it is say the question of collection of the credit receipts also. So credit sales also. So sales maximization is the objective of the firm, but at the same time collection of the receivables is also an important part. So we have to make sure that if receivables are safe and they are collectible at the time as and when they become due, then it is good, then it is fine. Otherwise there is no point selling on credit, blocking the funds and losing the sales as well as the profit. So that is not to be done. That will require even the extra efforts of the collection department and extra expenses on the part of collection department if their say efforts are required to collect the receivables, if we have sold the receivables to those people who are not say worth of say getting the credit. Now when we are going to talk about the credit policy changes, we will discuss and learn it in two parts. First one is the short term changes, and second one is the long term changes. Sometimes what happens, firm faces the short term problems. They do not change the policy as such for the long term, but for the short term they have to make some changes which otherwise the policy remains the same. They are not going to make any changes or effect any changes, but to deal with some short term problems, some momentary problems, we will have to change the credit policy. And the problems could be like, say the firm is facing the problem of increasing inventory, mounting inventory. It is not because of say it is not a regular feature, but just because of the short term changes in the market, or sometime when the firm passes through the cyclical trends. So there may be the reason that the sales get affected, and they will get corrected in the long term, but in the short term sales have negatively been hit, and we are not able to sell more in the market on the given credit period and the credit terms, maybe as well as on the cash. So we will have to relax it for some period of time, some short term changes, and then we will have to see that whether it is possible to pass on the inventory on the credit sales, because if you keep the inventory with you, you will have to incur the cost. So sometime we review it and we see that if we relax the credit policy for some period of time, is it worthwhile to pass on or convert that inventory into the credit sales? Are we going to collect those credit sales which additional we are going to make because of relaxation of the policy? So if it is possible, then we can relax it for the time being, and then we can say pass on the or convert that inventory into the credit sales. Sometime firm want to enter into a new market. So when you have to enter into a new market, you have to not to sell the product on the same terms as we are selling it in the say the market where we are a stabilized player. So in the new market we will have to give some relaxation to the new buyers, or just to induce the people that yes, they should come forward and they should buy the product of the firm, the alternative which is provided by the firm. So we do not follow the same credit policy which we are following in the stable market, and that is without affecting the interest of the existing buyers. When we move into the new market, existing buyers also understand that yes, firm has to introduce some policy changes, and there is no harm in that, and say new buyers, to induce the new buyers, to attract the new buyers, some additional credit period or some say liberty in terms of the sometime cash discount, or sometime if they want to buy on the credit and they cannot buy and sustain the product and the sales for the say given level of the credit which we are giving in the stable market. So, we will have to give them extended credit period, that okay, you keep the product and you try to sell it in the market, try to say familiarize the people with the product, and when you are able to pass on the product to the consumers and collect the price for that, you pass on our part to us. So, sometimes these are the changes. So, to deal with the cyclical trends, to convert the inventory, mounting inventory because of the cyclical trends into the accounts receivables, and sometime to enter into the new market, we will have to relax the credit policies and we will have to effect the changes in the credit policies, but these are not permanent, these are not long term. First we are talking about the short term part, they are not long term, they are only some you can say situational changes, and we are following the normal trend. To our old customers, to our new existing buyers, or to our say permanent customers, we are selling it on the standard credit period and at the same discount and the same other terms and conditions. But sometimes even to the existing buyers, when we relax it, we communicate it to them very clearly that this is as a special case, we are giving you the extended credit from 60 say for example 60 days to 75 or 90 days, but do not take it as a regular feature, and we will normally for the next consignment which you ask or you order for, you will have to have the same terms and conditions. So, short term changes are there, and we can say take the help of these changes and we can pass on that inventory to the market or to the channels of distributions or to the customers on the relaxed terms, but on a temporary basis, and it is communicated to the buyers also, to the standard customers also, that this change is a short term change, not a permanent change. So, you have to be very careful about that, and next time we will not be giving you the same credit terms, you have to resort to the old credit terms. So, if there is a short term policy change, then how the firm has to evaluate it. That see, when we are going to relax the policy, it means the objective in the mind is that we are going to increase the sales. So, we have to again take the help of the incremental analysis, that how much additional investment we are going to make in the accounts receivables, or when we are going to change or relax the credit policy, how much additional investment we are going to make here, and how much additional profit will be available. And if there is additional profit, then you must be clear that there is additional cost also. So, we will have to make a incremental analysis, that how much incremental profit we are going to have, how much incremental cost we are going to have because of the increased sales, and whether the profit is acceptable or not acceptable, or say we are going to end up a situation where the profit is certainly going to be there, and even part of the profit is converted into the bad debts also, or part of the sales is not recoverable, and if part of the profit, because profit is a credit profit, it is not a cash profit. So, part of the profit even is not recoverable, still whatever the profit we are earning on the incremental sales because of relaxing the credit policy, then that profit is acceptable to us. So, incremental change we will have to incur, incremental profit analysis we have, incremental sales we have to find out, incremental profit we have to find out, and incremental cost we have to find out, and then we have to make the analysis whether it is worthwhile effecting these short term changes or we should continue with the existing policy. So, let us make a analysis and try to learn that how to evaluate the short term changes, and how to take a decision that if some short term changes are required to be done by the firm, then how to go about it. So, is there any model available, is there any method available, is there any say formula available to find out that how to evaluate those incremental sales because of relaxed policy, and how much is going to be the incremental cost and profit? Yes, there is a model, there is a formula, we can use that model and we can try to evaluate whether we are going to end up at a profitable state by relaxing the credit policy and selling more in the market, or we are going to have same profit or sometime the loss. So, if we are going to have very negligible profit, even then, and if we are going to have loss, even then we are not going to relax the policy. But if the profit is expected to be there after all these calculations, then yes, we have to think about it seriously, because otherwise also keeping the inventory as inventory will create the problems, right. So, we can think about that profit should be there and profit should be substantial. It is not a nominal profit, but it is not a say you can call it as a minimum profit. There should be profit, figure should be the profit, end up is the result is the profit, and that should be the substantial profit. Then only we are going to take the decision in favor of the short term credit policy changes. So, let us learn that how to evaluate the short term changes in the credit policy. We have a small problem we have worked out here, and we will try to find it out that how to find the solution about it. Say for example, we have a problem here that Beta Limited is facing problem of the slow moving inventories, gathers information from its market intelligence that it can make additional sales of rupees 375 crores if it relaxes the credit policy up to 90 days from the present no credit sales level. This is a peculiar case. Company is presently selling on cash, entirely on cash, but their sales are lesser, and here they are facing the problem of slow moving inventory. So when their inventory is moving at a slower pace in the market, they have conducted a survey, and they found out as a report, outcome of the report is that they can sell further in the market for 375 crores if they relax the policy, or maybe they say start selling on the credit. Relaxing here means that is from zero credit to some credit. So their policy is not at all, no credit they are selling, from the no credit sales level to some level. So fraction of new sales expected to be bad debt is 2%. Out of this 375 crores, 2% will be bad debts. That is known to us. That is also as per the say calculations of the survey we have done. Cost of the goods sold, only variable cost, because here we talk about cost of goods sold, variable including collection expenses is 80% of selling price. In this kind of situation, only we consider the variable cost, because changes are only very short term. So in the short term, your fixed costs do not change, only variable cost changes. So we will have to consider that cost, and opportunity cost of the capital is 20%. So whether you invest in the accounts receivables, you invest anywhere else, your opportunity cost is 20%. So if you surplus funds, let's say 375 crores, if you invest in the accounts receivables, then what is the return available, and if you invest these funds elsewhere, then 20% return is available. So here also minimum 20% return should be available, so that opportunity cost becomes zero. Advise the company whether it should relax its credit policy or not. So now you see, it's a very peculiar case that from zero credit to, means it is clearly written here that from say if they relaxes the credit policy up to 90 days from the present no credit sales level, means it's a peculiar case that company is selling not at all on credit, entire sales are on the cash, and now they are thinking of that our inventories are not moving to the market quickly, so we will have to think of now selling it on credit. Right. Now let us evaluate this situation and try to find out that how we can evaluate this situation. Is there any model available for that? Yes, there is a model available for evaluating the short term credit policy changes, and that model is very simple because it is taking into account only the factorial part. What are the important factors involved? Important factors are, say, how much incremental profit we are going to have and we are relaxing the credit policy and selling more for 375 crores, how much additional sales we are going to make, how much additional costs we are going to have, how much additional bad debts we are going to have, and how much additional collection costs we are going to have. So all these factors have to be taken into account, factored into a model, and finally we will have to find out that what is the value of additional or incremental profits. So that is the important consideration here. So we will see here that how to deal with this kind of situation. So in the credit policy changes, say credit policy changes, and this is I am calling it as short term, right, not the long term changes. So how to evaluate that? For evaluating the credit policy changes, short term changes in the credit policy, these are the credit policy changes short term. We have a very clear cut model available with us. Model is small p is equal to s into 1 minus v minus s into 1 minus v minus bracket sv plus ivc into s by 365. We are taking the number of days in a year 365. We can sometimes take 360 also. So this is the model available here, that is P is equal to S into 1 minus V minus SB plus IVC into S by 365. This is the this is a small s, not the capital S. So we can take it as like that. It is a small s. This is small s. So this is the model. With the help of this model we can evaluate the credit policy changes and the incremental sales we are going to have because of relaxing the credit policy. Here if you talk about this, P is the say incremental profit, incremental profit. This is the incremental profit because of the relaxing the credit policy. In our problem which we have seen here is we are going to have incremental profit if we are selling more for 375 crores. So, this is P is the incremental profit. Small s is what? Small s is the additional sales. It is the additional sales expected due to credit policy changes. Due to credit policy changes, this is small s. V is, what is V? This is the variable cost. This is the variable cost of sales, variable cost of sales in percentage terms, not absolute, only percentage terms. This is V. Then what is B? B for Bombay. B is expected bad debt losses, expected bad debt losses as expected bad debt losses as expected bad debt losses as percent of additional sales, right. This is B for Bombay. What is I now? Here we have I. I is the opportunity cost of capital, opportunity cost opportunity cost of capital, opportunity cost of capital in percentage terms, in percentage term. This is I. And what is C? Here we have something term called as C, small c. It is the credit period. This is the credit period, right. So, these are the terms. So, this is the model, means I think we have factored everything in the model which is going to be as a consequence of the increased sales. So, we have factored everything here. You can say that we have the how much incremental profit we are going to have. This is P. So, because that is a major concern here, that if you have the incremental profit, then we go for the additional sales or relaxing the credit policy. If there is no incremental profit, then we will not relax the sales or we will not relax the policy, and why should we go for the additional sales? Yes, if there is incremental profit, fine. So, how to evaluate that? That take it as S into 1 minus V. S is the additional sales expected due to credit policy changes. V is the variable cost of sales in percentage terms. So, as I told you earlier, we consider only the variable cost because changes are only short term, not long term. So, if the long term changes there, I think we may consider the fixed cost also, but if the short term changes we are going to make, then only the variable cost has to be considered. And B is the expected bad debt losses, because when we are going to sell on credit, certainly the bad debts are bound to be there. Even sometime what happens when you relax the credit policy, even the existing buyers who are buying, say for example in this case they are buying or they are selling 100% on cash. So, it means if the product is like that, then the buyers of the channels of distribution are ready to buy from them on cash and sell it in the market. But if the company relaxes the credit policy, and apart from the cash sales, if companies start selling on the credit also, that even those customers who were buying on cash and who were very disciplined and careful while dealing with the company, they will also become relaxed, because now the company's policy is there, company has started giving the credit. So, we will also become little relaxed, and as a result of that relaxation, both the sides, one side will be gaining, another side will be paying the price, company will be paying the price and the customer will be gaining. So, as a result of that situation, you will have the bad debts also. And everywhere we have found it in the business history that when you sell on the credit and all the sales are not collected back, part of the sales remain uncollectible. In case of the banks also, we see that when the loans are given, 100% of the loans are not recovered back, part of the loans become the bad and banks have to bear the burnt or bear the losses. So, here we are going to have the additional expected bad debt losses as percent of the additional sales. Then I is the opportunity cost, whether to invest the funds in the accounts receivables or to invest the funds elsewhere, that is our choice, and opportunity cost is is 20%. Investing in the accounts receivables, opportunity cost here is 20%. So, we have to recover that cost also, means minimum return available should be 20% or more, because otherwise that return is also available elsewhere. So, why to make investment here and take the additional risk. And C is the credit period. How much credit period now we are going to give? If we are already selling on the credit maybe for 60 days and now we have to make that credit period 90 days, then also we will have to take the say additional credit period as a result of relaxation. And in this case the problem we saw that it is from 0 credit to now we have to start giving the credit. So, how many credit days or the credit period, how many days of the credit we are going to give. So, we will have to factor that also. So, we have factored profit also, sales also, cost also, bad debts also, opportunity cost also, and the credit period also. So, in our situation, let us see that how the this model works out and how the situation works out for us and what is the case. So, we are studying here that how many sales? 350 crores. It relaxes the credit policy, then the credit period is up to 90 days. So, we have to take the 90 days and bad debt new sales bad debt is 2% and cost of goods sold variable cost is just 80% of the selling price and opportunity cost is 20%. So, all the I think information is available with us. So, we can easily evaluate this situation with the help of a model, and here we have to see we will have to find out the P, right, small p. So, for calculating that, how much is the first thing was S. So, S is 375 is the additional sales we are going to make into 1 minus V. V is the variable cost and that is how much? 80%. This cost is 80%. So, this is V and then minus here we have next item is S. S is again 375 and what is the B? B is the bad debt loss. So, bad debt loss is here we are expecting is 2% plus additional item is what? That is opportunity cost and the variable cost. So, what is opportunity cost here? The opportunity cost is going to be 0.20 into the variable cost is how much? 80% into then is the credit. C is the credit period is going to be 90 days and again to be multiplied by 375 and divided by 365, right. So, we have put all the values in this model. We have put all the values in this model. So, if you solve this situation in this model, that is again let us check it again, no item should be left. 375 into 1 minus 0.80, that is a variable cost minus, right, we are subtracting everything from the 375 sales. So, and then that is 375 into 0.02, that is a bad debt loss, plus 20% is the opportunity cost of 80% and then because investment is only 80% not 100%, and then is the 90 is the credit period we are taking here, the 90 is the credit period divided by 375 into 90 is the credit period multiplied by 375 divided by 365. So, now if you solve this, so what will happen here? Your P will be equal to 75 minus, if you solve this it will work out as 75 into say 75 minus 7.5 plus 14.80. If you solve this, I am going to the next step directly. So, this is 75 is P is equal to 75 minus 7.5 plus 14.80 and that will be something like rupees. Finally, if you calculate, this will work out as 52.70 crore. This is the P, that is the incremental profit. This is the incremental profit. This is P, incremental profit. So, we are going to have the incremental profit of 52.70 crores if we relax the credit policy by 90 days from 0 and making the additional sales of 375 crores. Now, here one factor we have forgotten to factor is, let us see when we are converting the inventory into the credit sales. Why we have taken this decision of short term policy change? Because the company was following the or facing the problem of the slow moving inventory. So, they thought of that rather than keeping the inventory with us and bearing the cost of all kind of costs, that is the investment cost, carrying cost, handling cost, obsolescence cost, all kind of the costs, it's better to convert that inventory into the credit sales. So here when they are converting that inventory into the credit sales, so one important factor is that their inventory carrying cost will be saved. Their carrying cost will be saved. Investment cost will be there because that amount invested in the inventory is now invested in the accounts receivable. So that investment cost is same, but the carrying cost will be saved because their warehouse will be vacated. So they don't require the warehouse space, they don't require the people to take care of that, they are going to save the obsolescence cost. So anything which is related to the handling cost or carrying cost, that will be saved, and if that cost is considered here, then that cost will be now you can say that will further increase the profit, I would say, not decrease the profit, it will further increase the profit. So how you have to factor that cost here? You have to factor that cost here, that is we have the model actually P is equal to S into 1 minus B into SB plus IBC 365 plus this is the saving into the carrying cost, and that has to be calculated. G we add up here something on the right side is GSB. G is the physical carrying cost, this G is the physical carrying cost of inventory. So as a say a proportion of the variable cost, we will have to take it as the, it is a percentage of the cost of goods sold. So it means G will be saved and that G will be further added into the profit here. So once we have calculated the profit here, so that is 52.70 crores. Let us assume now that in this case G is equal to say 0.5%, right. This is G, this is 0.5%. We have assumed G. So what will happen now? This P will become, that is rupees 52.70 crores plus 0.005. This has to be into 375 because it is GSB. 375 into 0.80. So if you solve this, this profit will become something like rupees 54.20 crore. This profit is rupees 54.20 crores. This is not the 52.70 crore, this will become 54.20 crores. So P will be 54, small p will be 54.20 crores. So this is the actual effect of this is the actual effect of changes in the credit policy, and that to the short term changes. So we have seen here that additional profit by selling it in the market for 375 crores, additional profit we are going to have here is, that is 54.20 crores, which is a substantial amount, and we can see here that if you calculate, because when we are talking about 375 is not the the investment part. Investment we are making is only 80% because variable cost is going to increase. So we have to take the 80% of the 375 and not say entire amount of 375. So we are investing 80% of 375 and we are getting as a return 54.20%. So I guess this is a very good return, and we should seriously think of, the company should seriously think of say relaxing the credit policy and extending the credit in the market, because here we can assume that even the part of the sales, though we have factored up to 2% as a bad debt, but if more than that is also bad debts we are going to have, for example it is not 2%, it is 3%, even then I think this profit will be able to sustain those losses, and finally we are going to end up a situation whereby relaxing the credit policy for the short term we can increase the profit substantially, and the opportunity cost of 20% can be easily earned here. So it is better to go for relaxing the credit policy because multivarious effects it will give it to us. The aftermath effects are many, because when you are moving to the market and selling on the credit, it is helping us to expand the market, right. It is helping us to expand the market, that is one important consideration. When you are expanding the market, many say side effects, or you can say the byproducts of the additional sales also there. Your market presence increases, your market performance increases, market share increases. So initially we are say affecting the short term policy changes, we are increasing the sales by 375 crores, but if we think of expanding it on the long term, relaxing the policy on the long term basis, maybe it may convey a message in the market that this company is ready to sell on the credit and say say people who wish to do the business with the company but couldn't do the business because the company never gives a credit, or they give the credit period of very lesser amount of time. If they are now ready to give the credit and they are giving the credit as per the customer's requirements, so I think in that case it's going to be a very useful proposition, and many people may join hands with the company, and they can permanently expand the market. They can permanently increase their presence in the market, and overall increased market share will give them the many say you can call it as byproducts, and overall performance of the company in the market will increase. So by evaluating this situation and by taking the help of this model, we have tried to learn that if short term changes are to be done by the company in the credit policy, whether they can be done or not, and if they are done, then how much incremental profit is there and whether that profit is acceptable or not. Here when I am talking about is the profit, as I told you that this figure should be the positive figure, means profit, and the profit should be sufficient or substantial. So we have seen in this case it is a substantial profit, sufficient profit is there, but if there is a even some lesser amount also of the profit is there, we are ready to accept that. So now after evaluating the short term policy changes, we will have to go for the long term policy changes, and when you talk of the long term policy changes, some more factors have to be taken into account, because in the long term policy changes many factors their change. Number one is the changes in the accounts receivables, so that level will also increase. So investment in the accounts receivables will increase, and as a result of increased credit sales and accounts receivables, your other current assets will also increase. So how to evaluate the long term changes in the credit policy of the firm, that I will discuss with you in the next class. Thank you very much.